Welcome to the deep dive. This is where we plunge into complex information and try to pull out the clearest, most actionable insights for you.
That's the goal.
And today, we're doing exactly that. We're embarking on a really remarkable and, let's be honest, sometimes tumultuous journey into the story of a company that fundamentally shook up the world of finance. I'm talking about Robinhood.
Yeah, it's quite a narrative, and it
Yeah.
goes way beyond just, a simple trading app.
Right.
We're going to really dissect how this, daring startup, fueled by an almost audacious vision, went head-to-head with the entrenched establishment of Wall Street. We'll trace their path through a crisis that honestly could have been utterly catastrophic. I mean, it exposed some deep fissures in our whole financial infrastructure.
They really did.
And then, against what seemed like impossible odds, how they staged this improbable, almost Phoenix-like comeback.
Phoenix-like is a good word for it.
This deep dive, it's really designed to illuminate a path that could very well redefine how you interact with your own money and truly how financial services are probably going to evolve, in the very near future.
And unpack it we shall. That's our mission today, to pull apart this really intricate story.
Yep.
Our insights are primarily drawn from Chapter 1, Robinhood's Phoenix Flight, a financial rebirth. It gives this compelling, almost breathless narrative of their stratospheric highs and then those devastating lows.
Quite the roller coaster read.
Definitely. We'll also be leaning heavily on inside Robinhood's crypto-fueled plan for world domination, which provides a really cutting-edge, insightful look at their present strategies and, frankly, their incredibly ambitious future.
Looking forward.
And sort of quietly underpinning all of this, we'll connect with those deeper, more personal motivations for seeking financial independence. A theme that clearly resonated so deeply with Robinhood's early users. It's a spirit hinted at in From Wages to Wealth, the Investor's Code.
So what can you, our listener, expect from this journey today?
Good question.
Well, get ready for a story that kicks off with these audacious beginnings, then navigates a very public, very intense backlash that pushed them right to the edge.
Right to the precipice.
Yeah, followed by a period of quiet, almost stubborn resilience, and then culminating in this ambitious vision for a financial future that's, almost unrecognizable from what we understand today.
It really is a different landscape they're painting.
So this deep dive, it aims to give you a true shortcut to understanding one of the most significant disruptors in modern finance, and, importantly, what its trajectory might mean for your own financial journey and, the broader landscape of how wealth is created and managed.
Okay, so to truly grasp the audacity, the sheer nerve of Robinhood's vision, we need to first understand the world they were aiming to disrupt.
Context is everything here.
Exactly. Let's cast our minds back to, say, 2013. The global financial landscape was, it was still reeling, remember, from the aftershocks of the 2008 crisis.
Oh, absolutely. Trust in those big established institutions wasn't just shaken, it was shattered.
Yeah.
People felt like they'd been completely left holding the bag, that the whole system was rigged.
Yeah, there was a lot of anger, a lot of skepticism.
Definitely. And in that environment, where everyday folks were already skeptical, investing itself was essentially a gated kingdom.
That's a good way to put it.
If you, as just an average person, even thought about maybe dabbling in the stock market, you face these significant, almost prohibitive hurdles.
Like what specifically? What were those hurdles?
Well, the system was, you could argue by design, incredibly exclusionary for the average person. Think about it. The traditional brokerage firms, the gatekeepers, right? They typically charged anywhere from, say, $7 to $10 per trade.
Per trade.
Per trade. Let that sink in. Every single time you wanted to buy or sell a stock, whether it was 1 share or 100, you were paying that flat fee.
Which, if you don't have a lot of capital...
Exactly. For someone with limited capital, a $10 fee on, say, a $100 stock purchase, that immediately wiped out 10% of their investment before it even had a chance to move.
Just gone instantly.
Instantly. And on top of that, many of these established brokerages, they demanded minimum balances.
Yeah.
Sometimes thousands of dollars just to open an account.
Wow.
So this created an incredibly high barrier. It effectively shut out anyone who didn't already have significant capital or wasn't already part of that traditional financial elite. It was really a system built to keep the average person on the sidelines, just observing rather than participating.
So into this entrenched, kind of closed-off system steps this fascinating duo, Vlad Tenev and Baiju Pai.
Yeah, the founders.
And these guys were not your typical Wall Street types. You definitely wouldn't have seen them in pinstripes or, thinking like the traditional sharks of finance.
It's all outsiders.
They were genuine outsiders, looking at the system with fresh eyes and maybe with a healthy dose of disdain. What was it about their backgrounds that really shaped this disruptive mindset?
Well, they were indeed a unique pairing. You had Vlad Tenev, born in Varna, Bulgaria. He immigrated to the U.S. when he was just 5.
Okay.
He was raised by economist parents who actually worked for the World Bank. So you can imagine the kind of intellectual environment he grew up in, right? A household where global financial systems, economic principles, that was probably dinner table conversation.
So right, yeah.
He's described as having a mop of dark hair, a quiet intensity, and a brain wired for math that could solve equations in his sleep.
A math prodigy, basically.
By all accounts, yeah.
Yeah.
And crucially, he had previously built high-frequency trading tools for hedge funds.
Ah, so he knew the inside track.
Exactly. This wasn't just theoretical knowledge. He had an insider's view of how the Wall Street machine actually worked, how trades moved at lightning speed, and, importantly, where its inefficiencies and vulnerabilities lay. He saw the plumbing, the guts of the financial world from the inside out, and it clearly didn't sit right with him.
Okay, so that's Vlad. And then there's Baiju Pai, born to Indian immigrants, described as equally sharp-driven, a Stanford grad who, and this seems key, preferred to break rules than follow them.
That's the vibe, yeah.
It sounds like this wasn't about just tweaking the existing system for them, but fundamentally challenging it. How would you describe that shared conviction between Vlad and Baiju that really launched Robinhood?
That's precisely it. They weren't looking to just optimize a broken system. They wanted to smash the barriers that kept ordinary people out.
Right.
Their shared conviction was, well, the source puts it bluntly, a resounding, almost guttural "fuck that" to the existing financial system. It was a defiant rejection of the status quo. They envisioned a truly democratic financial system, one where access to markets wasn't some privilege reserved for the wealthy, but a right for anyone with a smartphone.
Anyone.
Anyone. They believed everyone, regardless of their net worth, should have the chance to participate in wealth creation.
And this conviction, this fuck that attitude, led them to the revolutionary Robinhood concept. Their idea was revolutionary in its simplicity, but incredibly powerful, right? An app so intuitive, so easy to use, you could literally trade stocks from your couch, from a coffee shop.
Yeah.
Anywhere.
Exactly.
What was the radical core promise that truly set them apart?
The radical core promise was just audacious. Zero fees, no gatekeepers.
Zero.
This was a direct assault on the industry standard, those $7 to $10 commissions that had been in place for decades. I mean, generations. It wasn't at a discount. It was free.
Which was unheard of.
Completely unheard of in retail brokerage at the time. And the app's design was equally pivotal. It was sleek, those green accents, clean lines, a swipe and tap interface that felt more like playing a game than using a serious financial tool.
Yeah, less intimidating.
Totally deliberate. It demystified investing, made it approachable, almost fun, especially for a generation that grew up with smartphones. It stripped away all that intimidating complexity you found on traditional trading platforms.
And the name itself, Robinhood, that was obviously loaded with symbolism, wasn't it?
Oh, definitely not accidental.
It explicitly symbolized taking from the rich, Wall Street's excessive commissions, and giving to the poor, meaning accessible trading for the everyday person. It was, as the source puts it, a middle finger to the old guard.
Yep.
A defiant statement against the status quo, a clear rebuff to how things had always been done.
And that defiant statement, it resonated profoundly. This revolutionary concept really started to take hold.
Right.
Robinhood officially launched in 2015, and the response was immediate. It was electric.
Well,
the app's design, its core promise, it drove incredibly rapid growth. By 2020, just 5 years after launch, Robinhood boasted an astounding 12.5 million users.
12.5 million in 5 years.
Yeah. This wasn't just incremental growth, it was an explosion.
It sounds like Robinhood wasn't just changing how people invested, but profoundly changing who was investing. Can you tell us more about that demographic shift? Who were these new users, and how did Robinhood really manage to democratize finance for them?
Yeah, you hit on a crucial point there. These weren't your typical day traders or, seasoned investors with big portfolios. The demographic shift was palpable, and it was fascinating.
Who were they?
We're talking predominantly millennials, gig workers, dreamers who've never owned a stock before.
Yeah.
They were individuals who traditionally felt completely excluded from the financial markets. mainly because of the high costs and the intimidating complexity.
Right, the barriers we talked about.
Exactly. Robinhood genuinely made investing accessible in a way it had never, ever been before. We saw these real-world examples that felt revolutionary at the time. A 22-year-old barista buys Tesla shares with her tips,
With tips.
literally from spare change.
Mm-hmm.
Or a mechanic throws $50 into Apple, just a small, manageable amount.
Wow.
These were people who, just a few years earlier, would never have even considered investing in the stock market. It was always perceived as something for other people.
So rich guys.
Yeah. Vlad Tenev himself framed it as democratizing finance. And in those early days, it genuinely felt like a revolution. For these users, Robinhood wasn't just an app. It was a tool to break free, maybe escape what many felt was that perpetual paycheck grind, and gain a greater sense of control over their financial futures.
So it was empowerment, really.
It truly embodied that spirit of wealth creation beyond just traditional employment. It allowed individuals to participate in markets previously reserved for the wealthy and the privileged. It felt like an uprising of the everyday investor.
But as with, well, any revolution, especially one that challenges powerful, entrenched systems, it wasn't going to be a smooth ride, was it?
Not at all. Predictably, no.
The very success of this democratization would eventually collide, pretty spectacularly, with the rigid realities of the existing financial infrastructure. And this is where we get into the infamous GameStop storm.
January 2021.
Yeah, January 2021. The market became, and I'm quoting the source here, a fucking war zone. Can you paint a picture of this battlefield for us?
It was pure chaos. On one side, you had these massive, slick, billion-dollar machines, the hedge funds.
The establishment.
Right, they were shorting companies like GameStop, which everyone saw as a strip mall relic,
Yeah.
selling video games in a streaming world,
Yeah.
and AMC, a limping movie theater chain.
Basically getting on them to fail.
Exactly. To short a stock means you borrow shares, sell them, hoping the price drops so you can buy them back cheaper, return them, and pocket the difference. They were betting on failure, expecting to profit handsomely when these companies went bust. A classic Wall Street play, betting against the struggling underdogs.
Okay, so that's one side. And then the unexpected counterattack. This is where the rebels enter the picture, right? The Reddit community Wall Street bets, described as a scrappy crew of gamers, students, regular folks. What was their strategy and what drove them to challenge these financial titans?
This was where the real defiance emerged. They were armed with, well, the mix of fury at the system and this wild idea. Their goal was clear and stated pretty bluntly online. Screw the hedge funds.
Just like that.
Just like that. It wasn't just about making money for many of them. They wanted to inflict pain on the very institutions they felt had rigged the system against them for years.
So pure anger fueling it.
A lot of it, yeah. Their strategy was to coordinate these massive collective purchases of the very stocks the hedge funds were betting against. GameStop, AMC, others driving up the prices artificially. Massively.
Force the short sellers.
Exactly. This was designed to trigger what's known as a short squeeze. As the stock prices skyrocketed, the hedge funds betting against them faced these escalating, potentially infinite losses. They were forced to buy back shares at higher and higher prices just to limit their damage, which of course only drove the price even higher. It created this vicious cycle for the short sellers.
It worked, didn't it? I mean, spectacularly. The short squeeze was a phenomenon. GameStop stock rockets from $20 to $483 in weeks.
Unbelievable numbers.
AMC followed suit. This was devastating for the hedge funds. Reportedly, they faced staggering losses of $13 billion.
$13 billion. It was a true middle-class uprising fueled by community, social media, and this shared sense of grievance.
And Robinhood, with its zero-fee trades and dead simple app, became the weapon of choice for these digital vigilantes, as the source calls them.
It was the perfect tool.
Reddit posts like, "To the moon," and "Hold the line," just capture the defiance and the sheer, almost palpable energy of this movement. It sounds like a David and Goliath story where David was actually winning.
It absolutely felt that way. For a brief, electrifying period, it really seemed like the little guy had finally taken down the giants.
But then...
The peak of this frenzy arrived on January 28th, 2021. And this is when Robinhood, the very platform that was empowering this revolution, drops a bomb.
What happened?
At the absolute height of this unprecedented volatility and trading volume, they restricted trading on GameStop, AMC, and several other of these so-called meme stocks. Crucially, users could sell their shares, but they could not buy anymore.
They turned off the buy button.
Essentially, yes.
Ah.
Imagine the visceral shock and the immediate outrage from the users who were in the middle of this battle.
And to those users, this felt like a profound betrayal, right? The app that had promised them freedom, the one that empowered them to challenge Wall Street, just locked the gates.
That's exactly how it was perceived.
The outcry was immediate and furious. Users screamed online, "Robinhood's protecting Wall Street, and they're not for us, they're with them." It was seen as the ultimate double cross, the company turning its back on its core users at their most vulnerable or maybe most powerful moment.
It was a gut-wrenching moment for everyone involved.
So what was Robinhood's explanation? Why did they do it? Was it protecting Wall Street?
Well, understanding the why behind the decision is crucial. It really comes down to this idea of survival versus betrayal from Robinhood's perspective.
Survival how?
The underlying mechanism here involved the clearinghouses. These are the vital but often invisible middlemen that actually settle trades. When you buy a stock, it takes a couple of days for the money and shares to actually change hands. The clearinghouse guarantees that transaction during that period, effectively taking on the risk until the trade is finalized.
Okay, the plumbing again.
Exactly. Because of the unprecedented trading volume and the extreme volatility of these meme stocks, these clearinghouses suddenly demanded massive collateral deposits from Robinhood. We're talking billions of dollars.
Billions. Why?
To cover the potential risk if trades went sour. If the price crashed before settlement, for instance, they needed this capital deposited with them immediately to ensure that every single trade could be completed, even if the market suddenly moved violently against Robinhood or its customers. It's a risk management requirement.
And here's the predicament. Robinhood, as a relatively young startup, wasn't a traditional federally insured bank with vast reserves of capital sitting around.
Right. They simply don't have that cash lying around. Not billions, anyway.
So they were forced to scramble, as the source puts it, raising $3.4 billion in emergency funding over a frantic weekend just to meet these sudden massive collateral demands and stay afloat, to avoid defaulting on their obligations to the clearinghouse.
So while to users it felt like a knife in the back, a deliberate act of protecting Wall Street, for Robinhood, they argued it was a decision based on sheer survival. They were caught between the immense demands of the clearinghouses, the regulators behind them, and the understandable fury of their own users. A rock in a hard place doesn't quite cover it.
The fallout from this decision was just immense, wasn't it? And far-reaching. It reverberated through social media, the financial press, and eventually the halls of Congress.
Oh, the public outcry exploded instantly. #delete Robinhood immediately started trending on Twitter. You saw screenshots of uninstalled apps flooding in as users visually expressed their anger and disappointment.
It was visceral.
Extremely. One particularly poignant post from a user read, "I trusted you with my last $200 and you fucked me." This wasn't just about losing money on a trade. It was about a deeply felt sense of trust being absolutely shattered.
And the repercussions went way beyond just angry tweets and people uninstalling the app.
Far beyond. Lawsuits piled up class actions, alleging market manipulation, claiming Robinhood had unfairly harmed investors by restricting buys.
And Vlad Tenev himself got pulled into the political spotlight.
Yeah, he was hauled in to testify before Congress, grilled under hot lights about Robinhood's actions, facing this bipartisan panel of really angry lawmakers demanding answers.
And then came the regulatory hammer.
Yep. In June, FINRA, the Financial Industry Regulatory Authority, delivered what the source calls a gut punch. A massive $70 million fine for misleading customers and system outages that left users stranded during critical trading periods. It was like a triple whammy. Public fury, legal challenges, and significant regulatory punishment all hitting at once.
The emotional impact on individual investors, the Jakes of the world, must have been huge. It's often overlooked in the big picture narrative.
Absolutely. Take Jake, for instance, this hypothetical user representing so many real people caught in the storm. His screen locks, his dreams ash. He tweeted, "Robinhood robbed me." Yeah. For many, this wasn't just a lost trade. It felt like a lost opportunity, a crushed hope for maybe achieving some financial independence. Yeah. This whole event, at its core, it starkly exposed the vulnerabilities of an frankly outdated financial system when it was confronted by this massive democratized market action.
The plumbing couldn't handle the pressure.
Exactly. It laid bare that inherent tension between wanting to provide widespread market access, which Robinhood championed, and the crucial, often overlooked need for systemic stability in the markets we all rely on. The traditional infrastructure simply wasn't built for this kind of rapid collective retail investor action. And Robinhood, despite perhaps its intentions, found itself caught right in the crossfire.
And that GameStop storm wasn't just a temporary blip on the radar. It was this seismic event that plunged Robinhood into what we can really call their darkest hour.
It truly was.
The company wasn't just bruised, it was financially bleeding. It was on the very precipice of collapse. Imagine the whiplash for them, their stock, which had soared to $38 right after their IPO.
Huge hype around that IPO.
Massive hype. By 2022, it had crashed below $10. This wasn't just a dip. It was a devastating fall from grace for a company that had ridden this wave of unprecedented excitement to its public debut. How deep did the financial devastation actually run?
The numbers really tell the story of that devastation. Revenues plummeted to just $1.358 billion in 2022. That represented a staggering 25% drop from 2021's high.
A quarter of their revenue?
Gone.
Gone. But it wasn't just about less money coming in. The company was actively hemorrhaging cash. They racked up a substantial $0.54 billion in red ink for 2023, $500 million in losses.
Wow.
This just wasn't a sustainable path, and the pressure internally must have been immense. Every single financial metric was pointing downwards, and the public perception was, frankly, abysmal. It really felt like a company struggling for its very existence. And this financial distress, as is so often the case, had immediate, brutal consequences for the workforce, for the people inside the company.
Yeah, layoffs became this grim, recurring event, a stark sign of the company's struggle just to stay afloat.
Can you describe the impact on their employees? It sounds brutal.
It was profound and, heartbreaking for those involved. In April 2022, 9% of the workforce gone. Just like that. Then, only a few months later, in August 2022, 23% more. That's described as a bloodbath that leaves the office hollow.
Almost a third of the company in just a few months.
Devastating. And then, heartbreakingly, there was a final, chilling round in June 2023. Another 7%, like a Grim Reaper's encore.
Good grief.
The office became metaphorically a ghost town. Employee morale was predictably in the dirt. You heard constant whispers of staff jumping ship, just unable to withstand the continuous uncertainty and the feeling of watching this dream unravel before their very eyes. These weren't just numbers on a spreadsheet. These were people's livelihoods, their careers being cut short as the company fought desperately for its life.
And this period also saw this deep, almost irreversible erosion of trust, not just internally, but with their most important asset, their users.
The very people they set out to empower.
Exactly. The barista who bought Tesla. The source says she was out, gutted, swearing off the app that had burned her Tesla dreams. The mechanic, he cashed out, spitting venom, just bitter about his experience. And our hypothetical user, Jake, he was gone, savings torched.
Yeah.
The initial dream of democratizing finance felt, at this point, like nothing short of a cruel joke to many of them.
And this erosion of trust was just compounded by an unyielding regulatory onslaught. Regulators swarmed, the source says. Fines for anti-money laundering slips, penalties for slow crypto withdrawals. The SEC, FINRA, state watchdogs, they were all circling, smelling weakness, eager to scrutinize every misstep, every vulnerability.
They were under a microscope.
Completely. Robinhood was, as the source vividly puts it, not just blooding, it's hemorrhaging. The central agonizing question that hung heavy over the company, and indeed the entire financial world watching this unfold, was simply, can they survive this?
Yeah.
For you, the listener, this period really represents the immense risks and consequences when truly disruptive innovation collides head-on with established systems and these unforeseen complexities. The vision was grand, maybe even noble, but the realities of market infrastructure and the unforgiving regulatory environment proved to be an incredibly harsh crucible. It was a dark, dark time for Robinhood.
So with the company right on the brink, bleeding money, bleeding users, facing this relentless regulatory onslaught, the focus shifts squarely to the person at the helm, Vlad Tenev.
The leader.
At just 34 years old in 2021, when his dream was quite literally on life support, Vlad Tenev didn't fold. He didn't crumble under the immense pressure that would break most leaders. What was it about his character that allowed him to endure this?
Well, his self-described pathological steadiness became incredibly evident during that congressional hearing.
Right, I remember watching that.
Yeah, imagine the scene. National television, angry lawmakers from both sides, intense scrutiny from the press. Yet he appeared remarkably calm, measured, facing down angry lawmakers like it's a chess match.
He didn't seem ruffled.
Not outwardly. And he didn't shy away from the responsibility. In fact, he took ownership of the situation with this remarkable composure, stating very clearly, we didn't want this. We had to act. It was a moment that showed incredible internal fortitude in the face of just overwhelming public fury and political scrutiny. It wasn't about avoiding blame. It seemed more about acknowledging a painful reality and a difficult choice made under extreme duress.
He also took on the role, apparently, of a general in a battered army, rallying his troops at a time when morale was, as we heard, completely in the dirt.
Yeah, trying to keep people going.
He told his team, "Our mission's not dead. We're going to fix this." And the source highlights that despite not being loud or outwardly charismatic in that traditional CEO mold, he possessed a steel in his voice, forged from years of proving himself. That quiet determination, that unwavering belief in their original purpose, must have been absolutely crucial for a company that was really on the ropes.
Absolutely. And this remarkable resilience, you can argue, in part, can be attributed to his background. Remember, he's a Bulgarian-born immigrant who fought for every inch, for his education, for his place in a new country, for his earlier entrepreneurial ventures. That experience likely instilled in him a deep refusal to lose now.
Immigrant grit.
You could call it that.
Hmm.
He fundamentally believes in the entrepreneurial spirit, the same spirit that resonated so deeply with Robinhood's early users. He said, entrepreneurs don't trust other experts to do their stuff for them. They like to figure things out for themselves.
Interesting quote.
Yeah. He saw Robinhood not just as a trading app, but as a control panel for those who want to manage their own money without gatekeepers. This wasn't merely a business for him. It felt like an extension of his own philosophy of self-reliance and empowerment.
And rather than despair or just give up, which many might have done, he digs in, plotting the comeback. This period really demonstrates that leadership during a crisis demands not just competence, but this unshakable belief in the mission, an almost stubborn refusal to quit.
Yeah, sheer perseverance.
For you, the listener, this really highlights the profound human element of leadership and perseverance in the face of just overwhelming odds. It's not just about the numbers on a balance sheet. It's about the resolve of the people guiding the ship through the absolute storm.
And what a comeback it has apparently been. Robinhood didn't just limp back from the brink of collapse. They've made an undeniable, resounding roar. 2024 is truly marked as the inflection point, the turning point, where their fortunes dramatically reversed course.
Yeah, the narrative shifted.
Completely. It's a story of strategic foresight meeting relentless execution.
Okay, so this rebirth wasn't accidental. It was driven by aggressive strategic acquisitions and a significant, deliberate product diversification effort. Let's start with their bold move into crypto. They're making a huge play for dominance there, which is kind of ironic given crypto is part of their original headache.
Absolutely. It's a fascinating pivot. In 2024, they made a really significant acquisition, Bitstamp. This is a crypto exchange that, importantly, has been around since Bitcoin was a whisper, meaning it's a long-standing, reputable player in the often volatile crypto space.
So established credibility.
Exactly. They acquired it for $200 million. This instantly propelled Robinhood into being a major player in digital currency, not just stocks. This acquisition unlocked crucial new capabilities, like offering perpetual futures with no expiration on Bitcoin and Ether for continental customers.
Okay, what are perpetual futures for people who don't know?
Right. They're a type of derivative contract that allows traders to bet on the future price of an asset, like Bitcoin or Ethereum. But unlike traditional futures, they don't have a set expiry date. So it offers continuous trading opportunities. It's a more sophisticated trading instrument that greatly expands their crypto offering beyond just simple spot buying and selling.
Got it.
And maybe even more critically, the source notes Robinhood began building its own blockchain. That signals a deep, long-term commitment to the underlying technology of digital assets, not just acting as a broker for trading them.
Building their own infrastructure.
Potentially, yeah.
And for U.S. customers, a significant development. Crypto staking. That was finally permitted. Explain staking quickly.
Sure. Staking is basically the practice of locking up your digital assets, your crypto coins, to help secure the network and validate transactions. In return for doing that, you earn rewards, usually in the form of more coins. So it's a way to earn income on your crypto holdings.
Okay, so passive income potential.
Right. This opened up a new revenue stream for Robinhood and a new engagement opportunity for their users. And the results, they speak for themselves. Robinhood's crypto revenue soared to $626 million in 2024. That's a massive jump from just $135 million a year earlier.
Huge growth.
Huge. This accounted for more than 1/3 of total transaction-based revenue. Crypto became a major pillar.
And the momentum has continued into 2025.
Apparently so. Crypto revenue hit $252 million in Q1 2025 alone. Industry experts are certainly taking notice. Some are bluntly stating that Robinhood was eating Coinbase's lunch in the U.S. right now,
Yeah.
in terms of retail crypto volume.
Really, beating Coinbase in retail.
In retail volume, according to these sources. While Coinbase still retains dominance in the institutional market, for the average retail crypto investor, Robinhood has, remarkably, become the preferred venue for trading. It demonstrates a swift and decisive pivot into this high-growth sector.
Okay, but they didn't just stop at crypto. They also made bold moves into wealth management and advisory services, clearly signaling they want to be a much broader financial services platform.
Yeah, moving beyond just trading.
In February 2025, they acquired Trade PMR for $300 million. That's a wealth management firm that instantly added $40 billion in assets under administration to Robinhood's portfolio. That's a big number.
It's a significant move, a clear signal of their intent to move beyond just self-directed brokered services and into managing wealth more holistically.
And then in March 2024, they launched Robinhood Strategies. What's that?
That's described as a disruptive new platform offering a hybrid robo-human advisory product.
Okay, hybrid. So part AI, part human.
Kind of. It uses algorithms, but likely has human oversight or availability, and is playing in the big leagues. For a remarkably low 0.25% annual management fee, which is capped at a flat $250 for the Robinhood Gold members.
That's very low compared to traditional advisors.
Extremely low. They're directly targeting old-school stalwarts like Morgan Stanley and Merrill Lynch in the colossal $60 trillion U.S. wealth management business. This platform reportedly brought in $350 million by late 2024, showing immediate traction in a highly competitive space traditionally dominated by high-fee human advisor models. They're essentially trying to democratize sophisticated financial advice, just like they tried to democratize trading.
This diversification seems absolutely key to their long-term stability. They're also enhancing their core customer offerings and building out loyalty programs significantly. A prime example is the Robinhood Gold Card, launched in 2024.
The credit card.
Yeah. It comes with no annual fee, packed with rewards like 3% cashback, over 100,000 sign up initially, and the ambition is clear. They want to reach 15 million users on Gold, which could mean close to $1 billion of subscription revenue.
Which fundamentally moves them towards a more stable recurring revenue model, rather than just relying on those volatile transaction fees from trading.
Exactly. Less dependence on market swings.
And Robinhood Gold, the subscription service itself, also offers compelling perks designed to capture more of a user's financial life. Things like 4% yields on brokerage cash, interest-free margin loans up to $1,000, and a 3% match on IRA contributions.
That IRA match is pretty powerful.
It is. The first 200,000 customers received the new card, indicating a rapid and aggressive rollout. Furthermore, they are strategically rolling out joint investing accounts. That seems like a critical move to pull families back in, allowing couples, parents, siblings to pool money together.
Rebuilding trust, maybe?
It seems like a subtle but potentially powerful way of rebuilding trust, one family at a time, showing a commitment to longer-term relationships beyond just individual traders flipping stocks.
They're also launching a whole host of other new products designed to broaden their appeal and capture more of the customer's wallet, right?
Yeah, a whole suite. We're talking IRAs, which are obviously essential for retirement planning.
Sure.
High-yield savings accounts offering competitive returns on cash. Even a private banking service for cash delivery on demand, which offers unprecedented liquidity for certain clients. And sophisticated options tools previously reserved mostly for institutional investors.
And the most surprising one, maybe, mortgages.
Yeah, a stealth online pilot launched in June offering home mortgages. Specifically, 30-year fixed mortgages at 6.1% plus $500 toward closing costs. That's a huge, almost audacious leap into the very core of traditional banking services. They're positioning themselves as a truly full-service financial partner.
Become your bank, basically.
Yeah, that seems to be the direction.
These aggressive strategic moves have, perhaps unsurprisingly, fueled a significant financial resurgence and really impressive user growth.
The numbers are strong again.
By late 2024, revenues hit $2.95 billion, up 58% from the year before, and the company dramatically flipped its net income to a substantial $1.41 billion, which is described, colorfully, as a middle finger to 2023's losses.
Yeah, that's quite a turnaround from hemorrhaging $500 million. It's not just recovery, it's a powerful statement of robust profitability.
And users are indeed flooding back, proving that trust, maybe once broken, can be rebuilt through performance and renewed commitment. By year-end 2024, they had 25.2 million funded accounts.
which is nearly double the low point
Mhm.
right after the GameStop debacle.
Wow. And the stories of renewed hope are illustrative, showing their original mission might be resonating again. The baristas trading crypto now, the mechanic eyes ETFs dreaming big, and even Jake's back scarred but buying.
Yeah, it demonstrates a deep, powerful reconnection with maybe their original user base, those everyday investors who felt blind but are maybe seeing a new value proposition.
And in terms of sheer scale and market share,
Their assets under custody, or AUC, that's the total value of client assets they manage, reached $255 billion. That's a significant figure. And they are now projected, according to the sources, to rival Interactive Brokers, which currently hold $665 billion in client assets within just 7 years.
rivaling interactive brokers. That's a big statement.
It is. Furthermore, they're gaining significant market share on Schwab, a venerable industry giant, for 14 straight months, apparently. That indicates sustained momentum and a powerful shift in the competitive landscape. This isn't just a comeback. It feels like a significant repositioning within the entire financial industry.
Okay, here's where it gets really interesting, I think. Moving beyond the immediate success to Vlad Tenev's grand vision for Robinhood's future, he outlines this in 3 sweeping arcs, which he describes as leading towards global domination.
Ambitious language.
Very. Arc 1, the immediate one, focuses on winning the active trader market, which is clearly evidenced by their current strong results in both crypto and options trading, right?
Yeah, that seems to be delivered right now. Immediate ROI.
Arc 2, this is a medium-term goal, maybe over 5 years or so, aims to serve the entirety of his customers' wallet.
The whole financial picture.
Exactly. Addressing all financial needs, from credit cards to crypto, mortgages, and IRAs. Essentially becoming a one-stop financial shop. And are actively diversifying revenue streams. Transactions now account for 56% of total revenue, down significantly from 77% in 2021.
So much less reliance on just trading volume.
Right. And what's more, they apparently have 10 different business lines on track to generate over $100 million each. That illustrates a powerful, multi-pronged approach to growth and stability. This arc is about deep integration into their users' financial lives.
Okay, makes sense. And then Arc 3.
Arc 3, the truly ambitious long-term vision. This is about building the #1 global financial ecosystem, which he presumes will have Robinhood's own blockchain as its backbone.
Wow. Global ecosystem on their own blockchain.
Yeah. Vlad believes the opportunities start slowly but compound over time. That indicates a patient, long-game approach to this massive undertaking, one that could fundamentally reshape financial infrastructure on a global scale if they pull it off.
And part of that long-term vision, the moonshot, as some observers are calling it, is tokenization.
Right. Explain tokenization in this context.
Well, Vlad's core belief here is truly profound. Could we actually put stocks on blockchains? He envisions a future where the value would be in taking stocks 204/7, eliminating traditional market hours, enabling continuous trading, much like crypto markets operate today.
So you could trade Apple at 3 a.m. on a Sunday.
Theoretically, yes. Imagine the possibilities for global investors if they could trade a U.S. stock at 2 a.m. their local time, whenever they want.
The challenges here seem significant, though, especially dealing with legacy systems. Robinhood initially tried to modernize by partnering with traditional platforms like Blue Ocean to extend trading hours, but as Vlad admits, those efforts hit a wall.
Yeah, he confessed, I didn't realize how difficult it would be to change these core infrastructure elements because so many things depend on them. Maybe that was a little bit naive.
So why is it so incredibly difficult to shift these established, deeply integrated systems? What's the big hurdle?
Well, it's kind of like trying to rebuild the foundation of a skyscraper while people are still working on the top floors. Traditional financial systems are built on decades-old, highly interconnected infrastructure. Every single aspect, from trading protocols to clearing, settlement, regulatory reporting, it's all deeply intertwined.
The complex web.
A very complex web. Altering one piece can have unforeseen, cascading effects across the entire system. Think about the hundreds of different institutions, banks, brokers, regulators, all relying on these systems to work in a very specific, sequential way. Introducing something as fundamentally different as 2047 blockchain-based trading, where ownership is digitally recorded and transferred instantly, requires a complete re-architecture of how capital markets operate. It's not just a software upgrade, it's a philosophical and logistical overhaul that clashes with deeply ingrained practices and regulatory frameworks.
Okay, so given that challenge, they took a different approach, particularly focusing on Europe as their test lab. Why Europe?
Primarily because Europe's existing crypto regulations, MICA specifically, are arguably more advanced and clearer than in the U.S. right now. This gives them a more defined regulatory sandbox to operate in. So Robinhood is running an experiment there. Starting in July, European users can trade these blockchain-based stock tokens.
Stock tokens, what are those exactly?
These are non-voting derivatives that track the price of hundreds of U.S. stocks and ETFs. And surprisingly, even private companies like SpaceX and OpenAI.
Private companies, how does that work?
Well, they're derivatives, so you don't own the actual underlying share, just a token whose value tracks it. And crucially, all of this is commission-free, 24 hours a day, 5 days a week. So it's a way to offer exposure, even to private assets, using this tokenized model.
Okay. Now, despite this bold vision and Robinhood's aggressive push, the current reality of tokenization presents its own significant challenges, right?
Oh, definitely. The market for tokenized stocks is currently minuscule. Platforms like X stocks, for example, show less than $10 million in daily volume. That's a tiny drop in the ocean compared to traditional stock markets.
It's early days.
Very early days. And there are structural issues, too. As mentioned, these tokens are derivatives, meaning they derive their value from an underlying asset, but that underlying asset is often held off-chain somewhere. This makes routine corporate actions like dividends or stock splits, especially if they happen over a weekend when traditional markets are closed, incredibly complex for collateral calculations and reconciliation on the blockchain side. Critics openly warn that these initial products, while innovative, could turn out to be duds if these complexities aren't smoothly resolved.
However, this hasn't stopped the industry from moving in this direction, suggesting Robinhood is certainly onto something, or at least not alone in thinking this way.
That's true. Other major players like Gemini and Coinbase are also entering the tokenized trading space. And you even have BlackRock CEO Larry Fink publicly urging SEC approval for the tokenization of stocks and bonds.
So the big players see potential.
They do. So while Robinhood is being particularly aggressive, tokenizing private companies like OpenAI and SpaceX, each valued at over $300 billion, it's definitely not without controversy. Some of these companies, like OpenAI, have publicly disavowed Robinhood's products, saying they have nothing to do with it.
Why would they disavow it? What's the issue for the private companies?
Well, it's a fundamental tension between the traditional equity ownership model and this new decentralized tokenization approach. Critics warn that founders typically don't want their private equity floating around on-chain with holders they don't know.
Loss of control.
Exactly. When you raise capital privately, you choose your investors very carefully. They sign agreements, they're part of a known cap table. Tokenizing these shares, even just as derivatives that track the value, introduces a level of public exposure and fungibility that many private companies, especially in their growth stages, are simply not comfortable with. It complicates future funding rounds, shareholder relations, and potentially control. It's really a clash of cultures, the open, permissionless ethos of blockchain versus the tightly controlled, exclusive world of private company equity.
Vlad, however, seems undeterred. He describes the current situation as still a little crufty, which I guess is coder slang for overly complex or clunky software.
It needs refinement.
But he remains confident. He envisions a future of self-custody where users are independent of the brokerage infrastructure. What would that truly mean for the average investor, being independent of the brokerage?
It's a profound shift in control and ownership. Imagine this. Instead of your stocks being held nominally by a brokerage firm in their centralized system, in street name, as they say, they would be directly recorded on a blockchain, owned cryptographically by you in your digital wallet.
So like owning Bitcoin in your own wallet.
Precisely that concept, but applied to stocks or stock tokens. You wouldn't necessarily need a middleman, a broker, to custody your assets. This could mean 247 access, potentially faster settlement times, and theoretically less reliance on traditional institutions that have historically served as gatekeepers and charged fees for it. It's ultimately about empowering the individual with direct ownership and control over their assets, removing layers of intermediaries. It's a future where you don't just own a stock, you hold it digitally yourself.
That's a radical shift. This vision seems deeply integrated with another ambitious frontier, artificial intelligence.
AI is everywhere now.
It really is. Vlad believes Robinhood will ultimately use AI agents to replicate and improve on the services of high net worth family offices, essentially putting a family office in your pocket. Okay, for those unfamiliar, what does a family office actually do, and how could AI possibly replicate that kind of personalized, sophisticated financial advice?
Right. A traditional family office provides really comprehensive, bespoke financial and personal services,
Yeah.
usually only to ultra-high net worth individuals and families.
Yeah.
We're talking investment management, complex estate planning, tax optimization services, philanthropy advice, sometimes even lifestyle management like booking travel or managing properties. It's an incredibly personalized, high-touch, and very expensive service.
Reserved for the very wealthy.
Absolutely. Vlad's vision is to leverage AI to democratize this level of sophisticated, proactive financial guidance. Instead of just giving you market data or basic tools, an AI agent could potentially analyze your entire financial picture, your income, spending patterns, assets, liabilities, stated goals, and then proactively suggest personalized investment strategies, optimize your tax situation, alert you to specific opportunities or risks, and even guide you through complex financial decisions like retirement planning or buying a home. All tailored specifically to you, much like a dedicated human advisor team would do, but potentially at a fraction of the cost and delivered with much greater speed and scale through an app.
A financial co-pilot, almost.
That's a good way to think about it.
And this isn't just, talk from Vlad. His personal involvement with AI seems significant, showing his deep commitment to this future. He recently co-founded and became chairman of Harmonic, an AI startup,
Right, Harmonic AI.
which is valued at $875 million, having raised $100 million in Series B funding. Harmonic is apparently building an advanced reasoning engine that, and this is key for finance, guarantees accuracy and eliminates hallucinations.
Which is obviously crucial. You can't have your financial AI just making stuff up. Accuracy is absolutely paramount when dealing with people's money. So focusing on eliminating those AI hallucinations is critical for building trust in financial applications.
He even muses about incredibly visionary goals, like using AI to solve profound mathematical problems like the Riemann hypothesis, maybe via a mobile app someday, which just demonstrates his deep integration of technology and this almost boundless ambition.
It really shows the depth of his commitment to pushing the boundaries of what technology can achieve, not just in finance, but potentially in fundamental human knowledge itself. It's a testament to his belief that advanced AI can tackle problems previously considered unsolvable, and that this power can eventually be harnessed, maybe indirectly, for everyday financial empowerment too.
So to bring it all back, Robinhood's not just alive, it seems to be thriving. The app that fell from grace, the one that faced that near-death experience, rises. Scars and all, a phoenix with sharper claws. This comeback really highlights the incredible power of adaptability, relentless perseverance, and having a clear strategic vision, even in the face of overwhelming adversity. It feels like a testament to their perhaps renewed belief in democratizing finance.
What an extraordinary ride we've really been on with Robinhood today, from that disruptive dream that captured the imagination of millions to a near-death experience that exposed the brutal realities and, frankly, the creakiness of the financial system.
Yet plumbing issues.
Exactly. And ultimately to this powerful rebirth with a bold, almost audacious vision for the future of finance. We've seen how resilience, strategic pivots into new high-growth areas like crypto and wealth management, and maybe an unwavering commitment to a core mission can transform a company from the absolute brink of collapse to a position of renewed leadership and influence.
Robinhood's story, I think, is a really powerful illustration of the ongoing seismic shifts happening in finance right now. It shows a clear trajectory moving away from the old fee-laden systems towards greater access, greater control for individuals. This deep dive, we hope, has armed you with a better understanding of the powerful forces shaping your own investment landscape, everything from the changing fee structures and the explosive rise of crypto to the truly transformative potential of AI in your personal finances.
So as finance rapidly moves towards this potential 24/7 AI-driven and increasingly tokenized future, and given the incredible speed of innovation we're seeing alongside the inherent challenges of disrupting these massive established systems, we'd like to leave you with this final thought. What aspects of your personal financial life do you anticipate will be the next to be completely revolutionized by technology? And maybe more importantly, how can you proactively prepare yourself to leverage these inevitable changes for your own long-term wealth building?